Welcome again to Money Discourse. The markets are continuing to be volatile. We had a nice rally over the last couple of months, but now, thanks to the Fed, we're back in the bear market. Rajan, tell us some more.
Wow, we've been on a bit of a break. Went back to the motherland, well, the UK that was good time. But coming back in the market is still just doing what it's been doing the whole year. It's been very volatile. And like Jason just said, we had a nice rally, but as the market is now readjusting their expectations from the Fed, we've now come off quite a bit, and we're down about 250 well, more than that, maybe 300 S&P points from the high, as the markets are recalibrating their expectations for interest rates. And so pretty much after the last inflation print, where it came in at 8.5%, it did spark this rally in the markets, as the market sort of priced in that we had reached a top in inflation and that the Fed was done in terms of the majority of their Fed rate increases. And then they thought they would taper off. We might get another 50, another 25, another 25, and we might settle at like 3.5% to 4%. But now the expectation's been changed following this recent, I think it was about a couple of weeks back when Jerome Powell spoke, and he actually used the words that the people will have to feel some pain in order to bring inflation down. And the fact that it's the first time the Fed actually have acknowledged that pain will have to be suffered for them to meet their goal, reducing inflation. And the fact is, it's a lesser of two evils. The thing is that you feel the pain now, but then in their eyes, and probably in my eyes too, the pain will be even more if inflation can't be brought under control, and it'll be a more longer lasting effect. So the thing is that this has now put a 75 basis point rate rise back on the table. So that would mark the third 75 basis point rate hike from the Fed in a row, which is, I can't remember the last time that actually happened. So that then caused the market to come off, and now all the tech is coming off. Like we've seen Square that got up to the $90 back down to like mid 65. All of these growth names have all come off. We've seen the commodities come off, apart from nat gas. Nat gas is still a dog, but we've seen the dollar so strong. What's a pound dollar right now? Like 115 or something. It's insane.
Yeah.
The pound euro dollar below parity is just massive dollar strength, and this is what we're facing right now.
Just on your point about the Fed, you notice that in the most recent meeting, Powell said the name Volcker twice in his speech. He's obviously signaling that there's going to be quite a bit of movement in interest rates. If you actually look at it, in the past year and a bit, there's been like a 10x increase in interest rates. It's like kind of unprecedented that it would be that much that quickly. Obviously, we're coming off stupidly low rates, which were too low for too long. So Liz Truss was announced as our prime minister, and she's got a lot of work on her hands. I don't think anyone can actually deal with this crap show that our economy is just obviously a huge amount of shocks in terms of power, like you were saying, Rajan. You had some interesting numbers to show about.
So let me show. So what it is we're looking at the biggest boon, and the biggest issue we have right now, obviously, is as we're coming into winter, is electricity prices, power prices, and where that will all lead us to, because this is the heart of the problem. It's the point of maximum pain which we're going to face. Now, if you actually look at all the other commodities, they've all come off nicely, and on a year-on-year amount, they're actually now come in. They've come off a decent amount. So if we look at the metals just quickly, gold is down over 6%, silver, copper down 20%, steel down 30%, iron ore. All of these were the ones that were going bananas in 2021. So we've had a drop off on that. Even if you look at the agricultural, like wheat, soybeans, all of them, they're double-digit gains, as in like 11, 12%, 18%, or 10% declines. But if we go down to electricity prices, and this is exclusive to Europe, this is where we see some insanely volatile pricing right now. So let's start with the United Kingdom. Currently trading at 410 per megawatt. It's actually down 15% today and down to 27% for the week. But year on year, the price of electricity is up 230%. On the month is up 16%. Now, Germany Germany, which is the most exposed to Russian nat gas, and they 55% of their nat gas come from Russia. And now we did hear during the week that Russia is now completely shutting down their Nord Stream 2 pipeline for maintenance for small oil leaks. And again, this follows on after Europe agreed to put a cap on Russian oil prices. So here's the Russian retaliation right now. And the thing is that, so we've seen in the last month, German electricity prices up 94%, but it's actually down 36% on the week, but it's up 16% on the day. But I mean, these numbers are wild, up 20-30% a day, down 20-30% on the day. But year on year, we're up 226%. Now, France, this is the one that's the big one. This is up 574% year on year. But on last week, we're down 44%, which meant that if we went back to last week, the beginning of last week, we were looking at over 1,000% increase in French electricity prices. So this is what's going to really, and then looking at Italy's 263% for the year, but it's down nicely for the day and for the week. And Spain is the interesting one. It's only up 10%, 10.5% for the year. It's actually down 21% for the day and down 13% for the week. And so Spain, although I'm not 100% sure, they have the least exposure to Russian gas. And so their pipeline, their levels of nat gas, the price at which they were able to get it, it seems to obviously been a lot better. So they don't seem like they will suffer as much. So this is what's actually happening right now. And this is where all the pain is going to be felt, especially coming up to that winter season. And depending on how cold it is, you were saying, we've spoken this about it before, but the average cost of a yearly electricity and gas bill in the UK is going to be what, threefold, fourfold?
I think the new cap that's actually just come into place is around 3,500 or something like that. And a couple of months later, that cap expires. You're looking at almost £5,000 a year average energy bills. And that's crazy because obviously a year or two ago, it was just in the 1,000s. So yeah, a lot of people are suffering out there. We saw in the Czech Republic, there was a massive protest. I mean, I'm telling you, with energy going this crazy, it's not just people heating their homes, it's businesses aren't able to get a lot of these subsidies. And if they're not able to produce their goods at a cost-effective price, they're going to be beaten out by international companies who can. And I know personally, at least for two businesses that are looking to shut shop because their business renewal rates for their electricity and gas is just too high. It doesn't make any sense for them to continue operating.
Germany, we've had this at BASF, which is the world's largest chemical company. They have said that if energy prices are like they are, and they will have to massively curtail production. A lot of these German names have threatened curtailing production at the levels of pricing that potentially it could be this winter, because it doesn't work out feasible for them to continue producing product. So the ramifications of this is huge. It's unbelievable. It's something that I have never ever seen. I don't know how this is going to all play out during the winter. I mean, if we just quickly look at the chart just for the S&P, same old chart we look at every week, every time we do it. So at this point here, this was obviously the low that we reached back in mid-June. And then I think was it the July or the August? No, it was the July inflation print that we got at the beginning of August that led to this rally. We already started to bounce off the low, but then we got to this stage and then we had this nice rally and we actually hit a high of over 4,300. And then we had those Fed comments and then we started to just all come back off again. And we're now trading back below 4,000. So we're actually at this support level over here. And if we do break it, I mean, straight away 37.50 could be on the cards and then back towards the lows in mid-June. So it is very difficult to know like how this is going to play out, because I mean, this is so macro driven that regardless of what the individual company's fundamentals are, the macro is ruling the roost right now. And the thing is that all stocks are just moving in one go. Like when it sells off, you could have a company that just had standout earnings. It will have its move, and then the next day it's down 20%, 30%. Like a lot of these companies that had good Q3 results are down 30%, 40% from the peak of their results. And so it's very difficult to pick these on a fundamental basis. So I mean, you might look at everything and go, this looks like a great buy, and it's still going to go down 30% because if the markets in general are just going to keep on collapsing under this weight of high nat gas prices and high electricity costs, and then the potential impact that will have to the overall economy, then it just makes no difference what that company is doing. It's going to be tough. To be honest, I'm still bearish, although I'm still long. But like, I'm glad I did cut. One of the things I was doing on that whole move up is I was trimming, and I just kept on trimming. And sometimes when it kept on going up, I kept on going, oh gosh, maybe that was the wrong thing to do. But sometimes you just got to lead with your gut, and then I'm glad I did that. So now the little pasting I'm getting is not as bad as it would have been had I not trimmed. So this is where we are. This is the particular situation. So, I mean, in terms of the trades now, I mean, I know you've been on the sidelines a lot more, paying it a lot more passively, but have you been doing anything more in particular recently?
It is difficult to be bullish in a market like this, and obviously when we had that bull run from June onwards, a lot of people were getting excited. I said in our last pod that makes me worried, and obviously this is why. But again, I mean, I've been looking around, scouring around for opportunities. Obviously, when there's blood in the streets is the time that you can potentially make great moves. Obviously, you have to have the time horizon for it. Because no one knows what the future is and no one knows where the low is. But you obviously have to just look at certain stocks that have large catalysts. And obviously, as you know, obviously I'm a huge Tesla bull. So I have been accumulating a few more shares last week on the dip. The main reason why is even though Tesla have been delivering profits for 2 years straight and building a huge cash position, really low debt, I think it's only got about 50 million debt or something like that right now. Tesla's still rated as junk by Moody's and the S&P. If you look at what was said by S&P's Nishit Madlani in response to a question saying that the Tesla upgrade will come later on this year. So that's something that I'm kind of banking on. And if you are wondering why it's a big deal, is currently Tesla is rated as junk, even though they, like I said before, they have pretty much the lowest debt in the automotive industry. I think there was a tweet out by Tesla Boomer Mama who wrote to Moody's asking why Tesla hasn't been upgraded. And they came up with a frankly BS excuse saying that it's the qualitative reasons because Tesla doesn't have too many models. It needs to expand its lineup. And well, the whole reason that Tesla is actually successful is because they haven't got a huge amount of cars. They've really concentrated on their two main best sellers. So it's just a bit of BS there. Obviously, Moody's will trail S&P. Obviously, S&P has already given that indication. And what that will mean is Tesla will be upgraded to investment grade. And when that happens, it means that institutions that aren't allowed, like big pension funds and the like, that have a certain restrictions on what type of equities they can actually own, it means that they are able to put money into Tesla. I think that at least, even if the market's going down, it should steady Tesla, and obviously there's going to be a whole bunch of front running on this, and I think it's now coming out that this is actually going to happen. Quite a few tweets have been put out by the Tesla.
I mean, see, the thing is about this one, how much, if you say, because the thing is where this really makes a difference in terms of the investment grade is if a company has a lot of debt and then their investment grade rating increases, then the cost of servicing that debt diminishes a lot. But if Tesla doesn't have that much debt, that it either means that they just, I guess the bull catalyst would be that they can now borrow at a more reasonable rate to fuel their expansion plans. Because if they don't have that much debt, it's not like they will save a ton on interest or anything like that. So the thing is, I guess that the catalyst will be now that they could start doing more offerings in the market to go fuel their growth.
I think that is obviously a valid point, but Tesla, their free cash flow is so high at the moment that they can fund pretty much any venture that they want to.
Apple got 250 billion. They're still doing. They're still in the market. The thing is that sometimes, Apple's doing, 6-part offering, 7 parts offering, even though they've got more cash than anyone. So the thing is that I think if you can borrow at a good rate, you would never use your own
Yeah, I
cash
think.
on hand. Yeah,
Yeah, so that's obviously very true. But the main point I made before is that some of these pension funds and other large institutions aren't actually able to invest in anything that's junk, right? So meaning
yeah,
they have to wait up with the S&P. So obviously with the debt situation, like you were mentioning, that's obviously very useful to Tesla. But I think that mainly it's these pension funds and other institutions that are going to hopefully at least stabilize the value of stock if everything's going down, or if everything kind of settles down. It won't be the same as Tesla being included in the S&P 500 as it was in 2020. You could see expecting something around 10-20% or something like that, potentially everyone trying to front run it. So then it might be a good time just to
yeah.
trade the stock, because
I think
it'll
if
be
the
quite
market
volatile.
conditions are good, definitely you can see that happening, because with Tesla,
Yeah.
despite the market cap, when it runs, it runs. It's
So, yeah.
insane the way it runs. But I mean, you were mentioning earlier as well, Cathie Wood. I'm not a big fan of Cathie, but she did her latest report saying that she thinks the market is bottoming. And what did you see in that one? We know that she's going heavy in Ginkgo Bioworks and some of these stocks. I mean, what did you see in that report?
The things that I was mainly interested in is obviously, first of all, the ARK fund has seen its biggest monthly outflow in nearly a year. Yeah, she's obviously still doubling down on Ginkgo and Zoom. And she was mentioning in terms of the automotive industry, GM is reinstating their dividend. That really made me question Mary Barra's leadership, because surely in a time like this, obviously she's putting it out there to show confidence, but it is actually a terrible move for the future of GM, because this is the time to be investing heavily into the transition to EVs. They're returning those profits to shareholders, which I think is a bit of
Yeah,
madness.
no, I just
Obviously,
want.
GM has also been called government motors, so because they're obviously going to get bailed out, so it's fine. It's
I
the
think I
taxpayer
think
that's going to
these
pay for it
dividends,
anyway.
with the dividend, all right, it depends what it is, because you could have a token dividend of a cent or something like that. So it'll be interesting what they do. But I mean, the buybacks right now. So I just wanted to actually touch on this, how real inept management, when you've got cash flow and you go start spending. So Snap, we've seen Snap. They had their pre-report recently, 30% drop on their earnings. Now they're announcing 20% staff cuts. They're doing a whole cost cutting plan. This is Snapchat. This is after they completed I believe, a $500 million share buyback program. So they had $500 million that they bought back their stock. And where do you think they might have bought them back at? $30, $25, $20, and the stock is now at 11, right? So their 500 million that they spent on stock buybacks is now worth like 200 million or something like that. And now they don't have that 500 million. They have to now do all these cost cuts, doing staff cutbacks, this and that. Like, this is where management, it's with these share buybacks. It's just, it's just bad. It reminds me of the airlines before COVID. Now, obviously, it's a very difficult to know that COVID's coming. Like, you can never foresee stuff like that. But all these airlines were doing huge buybacks. And what happened? COVID happened. They're all borrowing money off the Wahoozy from the government. And then, everybody's criticizing these buybacks because you had that buffer there and you just basically blown it with these. And maybe this is why, this is the thing with good management and not. And Snapchat is just the number one. Is cutting all these costs, doing all of this after completing a $500 million share buyback, which is ridiculous. But like you were saying with Cathie, like saying that it could be a contrarian indicator, massive outflows in the funds. Cathie, to be honest with you, it's just considering her main holding is Tesla, and the fact that she has not benefited, her fund does not even look like she owns Tesla in it, how badly it's done. Just shows that if you probably took out Tesla, that fund will probably be down 90%, because she's involved in every single non-money making company, which is the companies that are being the most destroyed right now in this market. No profits, no real path to profitability in the short term. And those are the core of her portfolio. And then this is why it is, her portfolio is her portfolio.
Yeah, but if you look at what else you're saying, that Walmart and others still have a lot of stock, a lot more stock than was forecast. So she's saying that we're potentially in a deflationary situation. We could have been, but again, the government comes to the rescue and does the Inflation Reduction Act and others similar to that, obviously printing money that, when we shouldn't be doing.
You know what it is? If you look at it, right, I've actually looked into this topic quite a bit, just trying to look at the dynamics behind it. And the easiest thing to say is government's printing money and that's why we're getting inflation. But if you actually look at it, we're not going to get no deflation because it's not the products which are causing the problems. It's supply side factors and the war.
Of
And so
course.
this is a man-made issue that's actually got nothing really to do with who's printing what. Although the huge printing that we got in 2020, 2021 has led to the problem. But the thing is, the real things that are causing the issues right now, because if you actually look at it, if you backed out this Russia war or the Russian conflict right now, and then all the nat gas, all the electricity prices went back to a normal state, then you know what? We would have a much more comparable and a much better inflation number. And just like you said, regardless of the money printing or anything, we've got all these retailers reported. We've got Target, all the US ones, inventory. We actually kept a good eye on the inventory levels. And as Cathie said, inventory levels are very high. So the deflation is happening in certain aspects in those categories, but that doesn't really make up for these massively high energy costs that we're all facing. And that has no real, that is not really being impacted by the Inflation Reduction Act or this act or that act. It's just happening because Germany sold their souls to the devil and now Russia's cutting off their gas. And then it's just as simple as that, and is it, well, obviously there's more behind it, but this is the main crux of what is going on. And everything that has happened prior to that, we had too much monetary and fiscal stimulus all in one go, which obviously led to this crazy type of behavior by all the consumers. And then what the companies, I feel like I knew it, but I don't know why they didn't know it. But it's like they all go, oh, look at the demand after they got their $1,200 stimulus check. Well, we need to buy hundreds of thousands more toilet roll. We need to buy everything like this. I would have thought management would have seen, okay, we can clearly see that demand is being impacted by all these handouts. Year on year, we're not going to get that same level of demand. But judging by the amount they produce, they still expected growth of these mega inflationary, mega stimulatory environments. And so I just look at management and go, like, the forecasting was poor. Like, what did you think these handouts were going to happen for life? So in terms of but then again, maybe it's a good thing they got too much inventory, so at least it helps the inflationary environment a little bit, because there's some good deals to be had out there. Like, people are trying to, in certain aspects, but the deflation ain't happening in the places we need it the most. Food, it's not happening. Energy, that's where we need the deflation. Rents, that's where we need it, not the price of a TV. We've got enough TVs right now, so this is the issue. This is the issue, I think. But yeah, anyway, we'll see how it all pans out. This whole thing, I think, for Biden again, it was unnecessary. They didn't really need to do it, but he has to have one win on his agenda. Everything he has tried since he's come into power has been blocked. It's clearly the political system doesn't allow anything to go through. It's always 50-50, 50-50. Everything getting blocked, and just for his presidency to show that, oh, look, we have done something, they had to get some type of bill through. And I think I mentioned this last time, the original bill was like 2.5 trillion, ended up now at 500 billion. It's a fraction of what it is. So it's actually a win-win both ways, because this was the heart of his election proposal, and it got through, but at 25%, 20% of the size. So although it's not necessary, it's better than being in the trillions. You know what I mean? So
on your point, in terms of it being a supply side, a shock, and that's what's obviously causing the inflation. So the Fed are obviously trying to react and change things from a demand perspective by raising rates. But what's your thoughts on why with all the technological innovations that we've had that Cathie talks about, why haven't supply chains caught up? It seems like they've had plenty of time. Obviously you look at the automakers still blaming supply chain issues, but
I think,
things have been
when I
okay for
look
a
at,
while. Well,
yeah, I think what it is that first of all, a lot of supply chains, it takes time to sort of get back into the normal thing. But I think the biggest thing is just labor, and COVID has changed the attitude of labor, right? It like I heard this story like at Goldman Sachs, more companies are pushing to get staff back in the office, and apparently people are now quitting Goldman Sachs because they don't want to come back to the office. Like, so you've got these staff, all these people are begging for staff at warehouses, at this, and then you've seen in the UK, and there's every industry is taking it in turns to strike, from like the bus drivers to the train drivers to the baggage handlers to BA staff to like every week there's from university people. They're all taking it in turns to strike. Everybody wants more money. And then what happens is it gets to a point where the real embedded inflation is going to be through wage inflation. So you're getting all of this high inflation everywhere through wages. And what's happening is a lot of these companies, they can't just run an efficient ship at the rate of labor, what everybody wants. And then so you're getting all this. So you're getting that. Second, you've got China, who's still living in the ancient ages, still locking down left, right, and center for COVID here, COVID that, with their zero COVID policy that I think they just don't have the balls right now to just reverse, even though I think they must know that's not a winning strategy. But I genuinely just think it's a good question. No one knows exactly really what it is, but I think it's just a shift of labor attitude, and that none of these supply chains have really been able to get the staff to be running at full capacity to get things back to the way they need to be, because the shifts, the mind, the attitude of so many people has changed so much since COVID. And I think if you can say what's the one biggest impact of COVID, it's been the whole shift towards going into a workplace to work. And now it's, you're seeing how many people are like quitting their job. They're telling me to come in 5 days a week. I quit. And,
on a reversal to that, what they're saying in terms of, because of energy prices, they're saying, especially this winter, is people actually want to go into the office to not have to pay to heat their houses the whole day, and it will actually drive people back into the office. So who knows? It might be an elaborate screen.
Yeah, the thing is that I don't know if this is really going to unravel. I do think there's obviously some companies that are going to keep this work from home dynamic, but it is a good point. I don't, you've seen these commodity prices, everything has come down a lot. And then I saw, see, this is where things, I saw the tweet by Elon Musk saying parts are getting easier to get. My friend at work, they have a reservation for a Model Y, which was supposed to be delivered in May next year. They brought it forward to February. Whereas from Ford, they still haven't, they're saying, sorry, we have to delay your order again because of this. And I actually went showroom hopping, and all of these guys are saying 7, 8, 9 months. So I also think there's a bit of an issue with where the profitability is. I think there's a bit of showboating. I mean, what's the right word? They are making it seem one way to make an excuse for not selling you something that they know they're going to be selling to you at a much lower margin or at loss. And so they're using that excuse, but then fulfilling other orders where they can have a higher margins and prioritizing that. So I think there's a bit of that going on too. But I mean, to be honest, yeah, it's a $64 million question. I'm not too sure, but yeah, I mean, we'll see if this really comes out. But again, with these energy prices the way they are, I don't think that's going to help going forward. But yeah, final thoughts. What do you think going forward? We're now in the last quarter. We just had Q3, last quarter of the year. Where do you think we'll be? Where do you think we're going to go?
As a market, I'm not sure. It really depends if the Fed are forward-looking or are they looking at past data and making their decisions looking in the rearview mirror. Obviously, this war has to end if this world is to kind of go back to any kind of semblance of normality and inflation kind of settles down. But in terms of the markets, I'm generally an optimist in the long term. Short term, it's anyone's guess what's going to happen. Hopefully this week, after everyone's kind of had their Labor Day weekend and kind of got off some of the crazy scared feelings that they were having last week because of Mr. Powell. Let's see how it goes. I mean, obviously it's anyone's guess. If you do have your powder dry, meaning you've got some cash sitting on the sidelines, you should just dollar cost average into your favorite stocks, so the ones you've got most conviction in. Obviously, if someone told you last year, maybe at this time, that, you could buy all these stocks at like fractions of the price, you'd be like, yeah, of course, I would love to do it. But when the environment is looking a bit bleak like it is right now, what do you do?
Yeah, I mean, and for me personally, same mantra, what I've been saying this whole year. When market goes down, hedging in around the core positions, and when it goes up, I'm trimming. I am selling every rally, but not obviously the whole position, but taking nips and tucks, because in this type of market where I think we're going to get these big swings up and down, I think there's just good chances to just keep on improving averages. And so like a lot of these stocks where maybe I've entered in earlier, for example, Square, like I remember I started to buy Square at 250, 260, and then just by taking bits off, putting it back on, taking bits off, putting it back on, I've now brought it down to an average of 90. And so that's the power of just playing this volatility. Like where this doesn't work is when we have a straight up market, which we've had pretty much for like in 2019, a lot of the front part of 2021 and some of the previous years. But in this current market, this strategy I think works best. Now, again, if we then start ramping up towards the end of the year, then it's great, but if we start dropping like flies, then it might be a bit of a problem. But
Yeah,
this is how it is.
I'm really concerned about legacy auto, especially the Jap automakers. Honda sales are down 50%.
Yeah, we actually saw
Toyota down
Ford was up
42%.
30
Yeah,
something. Like Ford has got its mojo back, but these Japanese, no, Toyota was not bad. They were down 9.8%.
42%. But they're 42% year on year.
That was nine. I have to double check it. It was one of them was down
No,
9.8% year on year.
Toyota sales were down for the past 3 months, were 42% lower than the same period last year.
The thing is, they've had a lot of shutdowns in their plants. It's just a big.
The thing is, I think it's all just masking the inevitable. Everyone that I know, pretty much, at least wants to change one of their cars for an EV. That's obviously where the growth is. And if you just look at even a Tesla Model Y compared to like a Toyota Camry, the cost of ownership, it makes more sense to get the Tesla Model Y in terms
prices.
of even with these electricity prices. And in the UK, it's going to be a tough sell for when it's at like 58 pence per kilowatt hour. That's going to be difficult. But we're just, you have to look at the demand of those cars compared to the internal combustion engines, which are obviously going to depreciate much faster. And obviously in this type of market, right now, if you were a used car buyer, you're paying, or you were looking to pay, massively over the odds for the same car just 2 or 3 years ago. We'll have to see what's going to happen now when obviously financing costs are going up for auto, so even getting into leases is way more expensive. And obviously when companies like Toyota, Honda, they're doing such low volume, it means that they need to raise the price up. They need to sell all those extras. They need to have the higher margin cars sell, or otherwise anyone can sell £10 notes for £9. But obviously, them as business people have to look out for their own back. But unfortunately, they've not made the right bet in terms of technology. I see BMW. I see Toyota coming on to a new collaboration for hydrogen. Obviously is a net zero, but it's just pointless. They should just be focusing on their EVs, but it seems like there's some corruption inside that's not allowing them to.
All right, so hope you liked what you heard today. Please like and subscribe if you like, and we'll catch you on the next one. Should be a exciting run into the year end, and let's just hope we don't crash, but we'll see.
Thanks.